It's Saturday morning at 10 a.m., so you know what that means. It's time for What's Up, Ocala? With tens of thousands of viewers every month on our YouTube channel and millions so far on TikTok, we are joined by our host, local owner, and broker of Great Expectations Realty, Andrea Praber.
Hey. Good morning, everyone. I'm Andrea Praber with Great Expectations Realty, and with me today, I have a very special guest. Why don't you go ahead and tell everyone who you are and what company you're with?
Hey, Andrea. Yeah, my name is Josh Heinz, and I am the Vice President of Strategic Partnerships with Lending One.
Okay, so Lending One, I was so excited to get to know you and your company because it was literally something that I was searching for. I work with a lot of investors, of course, being property management, we do. And it's rare to find a company that exclusively works with investors like yours does. Why don't you tell us a little bit about it?
Yeah, absolutely. So you're right. It is a little bit. It's not as uncommon as some people think. This industry, though, is niche, and so there's a lot of people that just aren't familiar with it. But private lending. So some people refer to hard money. Some people refer to private lenders interchangeably, but they're a little bit different. And so traditional hard money is somebody that's probably local to a given market. It's a high net worth individual, maybe a family office that has some funds set aside that they're wanting to loan on in their area. They know where 123 Main Street is in their market, but they just don't lend it in any kind of expansive way. Where we are really could be seen more as like a specialty mortgage shop or a specialty lender, where we only lend on real estate investment properties and we only lend to real estate investors, but we loan nationwide. So where, typically again, hard money is going to be somebody who's local to the market. We're local to the market in every market.
Very interesting. Okay, so what kind of it was kind of interesting talking to you previously. What kind of customers are you specifically reaching out towards? Because hard money, they're not quite as particular as far as who they're lending to. Of course, there's some stipulations stuff, but you have a very specific niche market that you really, really want to work with and work on. So who are you looking for?
Yeah, so it's pretty straightforward. For us, we don't work with people that it's their very first time buying an investment property. So newbies is not something that we typically do. But investors themselves is who we lend to. So generally speaking, you need to have one rental under your belt or a couple of flips. And so that's the way that we qualify whether somebody is an experienced investor or not. So if they have one of those two criteria, then we'll generally work with them. The other is based around how we're actually closing the loan. So we're considered a business purpose only lender, which means that we don't loan to individuals. We'll only close in the name of an entity. So if it's an LLC, a trust, or a corporation, we're closing in the name of that entity. We don't close in the name of the individual. And that's actually preferential for most people because most people are told, hey, you can't close in the name of your LLC, where that is quite literally the only thing that we do. But in terms of investors, size and experience, look, we loan to people who are buying their third rental. We loan to people that are buying their 30th rental or their 300th rental. We have, products that range the spectrum that I'm sure we'll get into momentarily.
Yes, absolutely. So because you're working with essentially businesses, entities, which quite frankly, I recommend doing an LLC anyway because of, liability issues. So for many, many, many reasons, you should have an LLC. But you don't rent based on, or you don't loan based on their personal income or finances necessarily. So what is it that you actually loan on?
Yeah, so we're just looking at the assets. So one of the things that's interesting about what we do, most people are very familiar with, DTI loans, right? Your debt to income.
Yes.
But we don't really loan based on that. We do what's called DSCR loans, which stands for debt service coverage ratio. And in those type of loans, we're just looking at how does the asset perform. And a
Right.
very simple way to put it is if you've got a mortgage that's $1,000 and you can rent that property for $1,100, that $1,100 over your $1,000 is a 1.1 times coverage. So you're covering that mortgage by 1.1 times, and that's what we're looking for. That's generally going to be the minimum threshold for where we're going to create those loans. But so long as that rent or the projected rent is going to cover the operating cost of that property, then we're going to loan based on the asset's performance, not on your personal. So we don't look at W-2 income. We don't care about that, which is probably music to the ears of a lot of investors. A lot of investors are poor on paper, but rich in assets. And so we're not checking your W-2 income. We don't care about your tax returns. Again, we're looking at, what is your experience as an investor, and what is the property that you're looking to purchase? How is it going to perform?
Really, I mean, you're basically looking to see how serious are they. I mean,
Yeah.
just by having those few things set up, it shows whether they are a professional investor, if it's a true company, or if it's just something that they're dabbling in. So it's kind of interesting. I thought that was very interesting when I was speaking to you. So what about credit? How does credit come into this? Because you are doing the entity, but normally an entity is still going to go off of the personal credit. So how does that work out?
Yeah, that's a great question. So for everything that we do, and whether it's a DSCR loan, which these debt service coverage ratio loans are 30-year fixed loans. So whether it's a DSCR loan, if it's a fix and flip loan, so if you're just wanting to buy something, rehab it and turn around and flip it to sell it. If it's a new construction loan, if it's a portfolio loan where we take 3, 5, 10, 50 properties and we package them into one loan, and then it's one loan, one payment. Regardless of any of those different loan products that we have, everything is based on credit and experience with us. So if you're looking at a DSCR loan, even though we're closing in the name of the entity, there is a personal guarantor on that loan. And so we're going to look and see what the credit is. And then depending on what rate you're going to get, is going to be heavily influenced by what your personal credit is, not so much the entity. That, again, that's what we're closing in the name of, but the person behind that entity is somebody that we're going to be checking their credit on.
Okay. So what kind of rates can we get here? Like what's how does the down payment come into play? What's the expectation of, like cash out of pocket?
Yeah, great question. So we have a minimum 20% down. So that's kind of the entry point on the DSCR loan. If you're a fix and flip buyer, so if you're just wanting to go buy a house to flip it, we do as little as 10% down on those. But on the 30-year fixed, it's a minimum of 20% down. It looks a little bit different if you want to do a cash out refi, but for a purchase, it's a 20% down. And the rate, again, depending on where you are with credit. So 760 and above, 760 is great, right? 771 or 800 all qualifies the same as what 760 does. So, but for right now, if you're looking at if you're 760 or above and you're putting 20% down, then we're going to be right at around 6.1 on our 30-year fixed loan. However, if you want to be a little bit lower on leverage and you want to say put 30% down or 40% down or 50% down, then we can certainly do loans at this time, again, kind of on this date. We never know where interest rates are going to move, but we can be somewhere in the fives if you want to be a little bit more on the down payment.
And of course, we have to put in the disclosure that that's as of today, this hour, this moment. We don't know what's going to happen tomorrow. I cannot predict the future. You cannot. I don't know that you can, but I seriously doubt that you can predict it as well. But that's for today. That's what's going on right now. Of course, we just had some interesting stuff going on with the Fed and all that. So I mean, it can change hourly, right? So
yeah, 100%.
Yeah. So we do want to say, as of this moment, accurate numbers, and that's what we're going for. But for the day that it depends. There we go. That's the disclosure. That's the legal terms at the moment.
100%. Yeah, we
I
don't
don't
know
normally have to put those in.
what's the Fed, the economy, the election, what type of impact
Oh
is
my
that going to
goodness,
have
the
on rates?
election.
We don't know. It will have an impact on rate. What type of impact it has, if it's 1 basis point, if it's 3%, we
Yeah,
don't know. But as of today, that's where we're sitting.
awesome. Okay, so is there a cap? Like if somebody comes in and they're like, I'm all in. I've done this before. I want to do 50 houses, or I want to do, I don't know, a massive commercial complex. Like what's the max? Where's the cap on this?
Yeah, so we loan anywhere from as little as $75,000 up to $200 million. So for people that are if you're looking to buy a portfolio of 100 and some odd properties or 200 and some odd properties, if you want to buy a build for rent community, we can certainly finance that. If you're wanting to do $125,000 fix and flip in your local neighborhood, we can do that. So there really is no cap in terms of the total number of assets that you can lend with us.
Awesome. Okay. I know I'm like grilling you. I feel like I'm grilling you, but
Yeah,
there's
no,
just
please bring it on. I love it.
so many questions that people have. And I'm like,
Yeah.
I don't know, but I'll ask somebody. Okay. I will tell you truthfully if I don't know, but I will find somebody. And I found you and I'm like, oh my God, finally. So really, really cool. So how is the let's see, for an ideal ratio for this loan approval, what is, I mean, we kind of, but what is the DSCR calculated? Like, how is that calculator? How did they do that? Because it's not going off of necessarily credit and it's not going off of, so how exactly are they doing that?
Yeah, so there's a matrix, right? So if you have really great credit and you want really low leverage, so if you're going to be 50% down and you have amazing credit, you're going to get the best of the best rate, right? If you're going to
Right.
put 50% down, but you have really, really terrible credit, you're still going to get a good rate, but it's not going to be quite as good. If
Okay.
you have really, really great credit, but you want to put little down, the rate's going to be a little bit higher, right? So it's a matrix where the best credit and the lowest leverage are going to get you the best rate. And then as you move those, it's going to adjust your rate just a little bit. Look, the average person is probably going to come in somewhere in like a 720 credit score, and they're probably going to put down anywhere between 20 and 30%. That's kind of
Yep.
the average of what we're usually going to be looking at. And for that person, they're going to get a rate right now somewhere in probably the 625 range. If they're going to be 20, 25% down with a 720, 730 credit score, something like that. And again, if they want to leverage up a little bit, if they want to put a little bit more down, the rate's going to come down a little bit. If their credit somehow they can get it to quickly perform well, then the rate's going to go down a little bit. But it's just a matrix of a blend between those two things.
Awesome. Thank you. All right. So for me, of course, I would love to sell $200 million in real estate. I would. But of course, like your company, my own, I have a very set specific type of customer that I'm looking for as well. So normally for Central Florida, because we do all of Central Florida, it's primarily going to be single family homes. Of
Mhm.
course, we have condos, we have townhouses, we have commercial, but primarily in like 100-mile radius, it's going to be single family homes. So is there some specific, like, is it different for commercial properties? Is it, are the numbers going to be different? Like what do you do and not do?
Yeah, great question. I appreciate you asking that. So we are very specifically right now in this season in the single family 1 to 4 unit space. So we're going to finance, true single family detached. If it's a townhome, a duplex, a triplex, a quadplex, we're all in it all day, every day. That's what we do, thousands of times per year to thousands of investors across the country. When it comes to commercial, so let's talk about like if it's a mixed use space, right? So if it's a loft that's sitting on top of a garage, that's not something we're typically going to look at doing. If it's a multifamily, so if it's parceled at 5 units or more, at least at this time, we do think that probably at some point in the future, we'll probably look at moving back into commercial and multifamily lending. But at this moment, we're only lending on single family 1 to 4 units.
Okay, awesome. Yeah, there are some parcels here where they're duplexes or even single family, but they're all on the same parcel. So it kind of, there's some weird gray areas, but I think we've
Right.
talked
And
about
we
it, just basically
always
what I
can,
call you.
we can look at and evaluate those one-offs, right? So if there is any question, we'd rather, take a look at it and be able to, because we can say quickly, you give us the address and we can look it up and say yay or nay.
Right.
There
Right.
are plenty of one-off opportunities where we say, hey, this is a little bit outside of the box, but we're still going to do that.
Okay. So another question. We have a lot of people that are really excited about Airbnbs and short-term rentals.
Yeah.
It can be very lucrative. It's a heck of a lot of work, so we're very careful with which properties we do that with. But we do have quite a few that are interested in it. Can this be utilized for that, or is that just going to mess with the numbers?
Yeah, 100%, 100%. So we do short-term rentals. The majority of what the DSCR product is around long-term rentals. However, we do have a short-term rental product that's pretty similar. The way we evaluate the property is a little bit different, right? Because if it's a rental, if it's a long-term rental, the financial performance of that, the vacancy rates, all of those things that would go into a short-term rental are going to look very different than a long-term rental. But we certainly do all the time dealing with Airbnbs and short-term. So we
Okay.
100% cover that.
It's a very popular thing. I think there's some people on TikTok that are inaccurately saying that they can just sit back and collect the money. It is not,
Well, if you can
not like
find a
that.
business like that, please send it my way. I don't know about sitting back and
Oh,
collecting anything. If you
if
find it,
anybody
don't worry
has
about
any questions, I can absolutely guarantee those are actually way more work and more nonsense comes up
it. Oh, yeah.
than the long-term rentals. Okay, they are most of the time more lucrative, but the headaches are beyond anything you can imagine with those. So we're very, very careful with what we take on those. So I can understand you guys, same thing. So,
Yeah, sure.
all right. So mostly what we've been seeing over here in the last few decades that I've been doing this is a lot of investors they have investments already, let's say in California, Oregon, state of Washington, maybe some of those states that are not quite landlord friendly, and evictions take longer than my child has been alive and she's about to graduate high school. So, for something like that, where they're wanting to sell their 1 or 2 or 10 investment properties over there and do maybe a 1031 exchange over here. And they're like, well, I'm going to go ahead and do cash. Like, what's the difference between using the cash, doing a 1031 exchange, and maybe getting more properties and doing, doing that towards like a loan? Like, what's the difference really?
Yeah, no, that's a great question. It's a lot of what we talk about, and so, you know, the number one rule, some people say the number one rule of real estate investing is using other people's money. And so we are frequently those other people, right? We want to be the other people's money. And so we have a lot of these conversations about, hey, if you've got a lot of money in cash, why take it and put it on one property when you can spread that and invest in a lot of different assets? And so you and I had a conversation about having some people from California that were looking to 1031 into your market. That's certainly a pretty frequent thing. And so I actually put together a little something. I'd be happy to share if it's okay with you.
Yes, please.
Um,
Yeah, absolutely. Anything where you've got facts and figures. I know investors love facts and figures.
Oh yeah. So we'll go and I'm gonna shrink this down a little bit
Oh,
so we can kind of walk through it piece by piece.
that's
So
great because that was very intimidating just now.
yeah, no, we don't want to bring up too much too fast. So we're gonna look at two different scenarios. One is for a buyer that's financing their properties, and one is for a cash buyer. So I know there in Ocala, you have, there's a lot of properties you can get, which is very unlike many places in the country. You can get properties that are 250, $300,000. So wanted to walk through using as a proxy a $250,000 purchase price for an
Mhm.
investment property, and presuming that somebody that may be 1031ing from California or for Oregon or Washington or New York, and wanted to invest in Ocala, which is an amazing market. I just read some really cool stuff about some industrial stuff that's going up there. So I know it's
Oh,
growing. You got a lot of investors that are looking,
we
which is
are, yeah, we're moving and shaking over here. It's fantastic. Yeah.
yeah, heck yeah. So if somebody had $500,000 that they were ready to take out of equity and they wanted to transfer that, and they had two different options. Option one was I'm going to take my equity and I'm just going to buy a property in cash. Option two is I'm going to take that equity and I'm going to spread it across a couple of different investments. Want to walk through what that looks like. And so, as a disclaimer, what I want to put out there is this is as of today, which is September the 25th, 2024. So the rates that we're looking at, the information we're looking at is kind of as of today. Things can always change. This is not to be taken as investment or legal advice. So check your own numbers, talk to your own people. We'll kind of walk you through a little bit
All
of
the
what
disclosures.
all the disclosures. So, but what people are typically going to look at that, the type of things that we look at every day are situations similar to this. So, what we're going to do is we're going to first look at a purchase price, right? So, purchase price being $250,000, both sides. The loan amount, though, so if you're going to be buying it in cash, you're just buying it in cash. But the loan amount, we're presuming for all of these a 20% down payment. So you're putting $50,000 down. You've there got then a loan of $200,000. We're also presuming that the monthly rents on these are going to be about $1,950 because Andrea, as we've talked, you feel like that's probably going to be a relatively accurate rent range for the average 3-2 that's got, $250,000 purchase price.
Okay, so if I'm understanding the numbers right here, the finance side, they're buying 10 houses, and the cash side, they're buying 2, right? Is that what I got?
Right. So the idea is thank you for that clarification. The idea is we're taking that $500,000. And so with $500,000 in raw cash, you can either buy two $250,000 homes. Again, we're
Right,
not taking into account closing costs and other things. So we're just
right,
going a little bit more elementary, but $500,000 is two $250,000 properties, or it's going to allow you to put $50,000 down on a property 10 times. And so
right.
$50,000 down on a $250,000 property is going to be 20%. So you're going to be able to put 20% down on 10 properties with that same $500,000.
All
So
right, I got it.
yeah.
I'm with you now. Okay.
Yep. And then on the rent side, that 1950 is roughly what you would expect for
Right,
your average rent range there in Ocala. And
right.
then as we talked about
New
it,
construction, basically. I mean, this is essentially a 3-bedroom, 2-bath, double car garage, quarter-acre lot, concrete block, new construction home. That's basically what I'm looking at for this amount, for these amounts.
that's unbelievable. If you don't wind up, connecting, 1,000 homes out of this video, I'll be shocked because that is not available in most of the United States. So the
We
fact
have
that
a
you've got
slew of
a
them.
market where it still is absolutely incredible. So we're presuming 1950 is the rent that they're going to get. Annual taxes, we're saying they're going to be $2,500 annually. Insurance $1,100. You see what that breaks out monthly at $208 and $92 respectively. And then we've got again 760 credit with 80% loan to value. Is going to get you today 6.16% is the rate for us that we're looking at on this DSCR loan. And just to point out again, one of the things we're looking at, so you see here, principal and interest 1220, 200, call it 14, $1,500. If you're renting something for 1950 and the principal, interest, taxes, and insurance are 1,500, that is well over your 1.1 times coverage ratio that you need to qualify for one of these DSCR loans. So you've got there your principal and interest, and then you can see your net cash flow on the finance property is going to be $430 a month. Your net cash flow on your cash property is going to be $1,650 naturally because you don't have any principal and interest payment that is going on with that. And so if you're looking at your net cash flow, if you're on 10 properties, that's going to be $4,300. Your net cash flow, if it's 2 of these properties for your $500,000, is going to be $3,300. And then the big thing that we want to look at is, cash is king, right? So what is your annual cash flow on your 10 properties? Now, look, we're not including within either one of these scenarios, we're not including vacancies. We're not including maintenance, costs or any of that. But if you're buying a new home,
You're not
then
going to have
likely
any.
there's going to be very little maintenance costs involved.
Right.
And so annual cash flow For your 10 properties, is going to be 51,000, and then annual cash flow for your cash buyer is going to be 39. So that looks pretty good, right? So a little bit more money on the cash flow side for your finance buyer. But one of the things that a lot of people don't take into account is the power of real estate really lies in the appreciating value. And
Absolutely.
so what happens when a property at $250,000 appreciates at an average of, and we're 3%, I think is a relatively conservative. Look, I don't think it would be fair to presume the 10.5% we've seen over the last 5 years. So we're going to come back to the historic norms. We're going to talk about 3% per year. So 3% of appreciation per year. When you break that down over 5 years on 10 properties, you're going to be talking about an appreciative value of $398,000. Appreciation on those 2 homes is going to be $79,000. So you're certainly getting a lot more on the appreciated side with that real estate when you're spreading it over those 10 homes. And then you've got total cash flow over those 5-year periods. So look, we're just taking over those 5 years, what is your annual cash flow? And then we're multiplying it times 5. So that's going to give you $258,000 over 5 years. As a cash buyer, it's only going to be $198,000. So then the total value, when you look at both the appreciation and your cash, is going to be $656,000 over 5 years with your 10 finance properties, or it's going to be $277,000 over your 5 years with your cash properties. And then when we're just looking at cash on cash return, that cash on cash return, when we're taking into account the appreciation, so keep in mind, we're including the appreciation in this, is going to be 31% over those 5 years. And it's going to be, you haven't quite made your money back. So your cash on cash return is going to be negative over those 5 years as a cash buyer. And then your average annual cash on cash return, then if you look at it over that period of time, is 6% when financed, or 8 or so percent if you're a cash buyer. So if you're looking at this, you're probably thinking, okay, well, if I could do either one of these things, they don't sound great. I could put my $500,000 into a S&P, spider fund, and just track the index, which has averaged 10% in the last 100 years. So why would I not just do that? Well, we're going to get to that. So when you look at this over a little bit more time, the average investor isn't holding that property for 5 years. They're going to be holding it for 7 to 10 years. So when we look at when an investor is going to hold that property over a 10-year period, we can see how things really ramp up. So the appreciation is the number one thing to kind of jump off the screen. Appreciation, again, presuming 3% per year over 10 years, now over 10 property has gotten you $859,000 in appreciated value over those 10 properties. The appreciation on those 2 properties over 10 years is $171,000. So obviously there's a huge delta there. And then cash flow, and again, this is pretty straightforward. We're taking this annual cash flow of $51,600. And again, we're not presuming rent is going to increase, right? So rent's going to continue to go up. And so ideally that's going to increase, but we're trying to be conservative with these estimates here. But total cash flow over those 10 years, if it was fixed, would be $516,000. Total cash flow with your 2 properties is going to be $396,000, which gives you your total value for those investments for your 10 properties is $1.3 million. And so what that is taking is your appreciated value of $859 and adding on your total cash flow over those 10 years. And so the total value to you over that 10-year period is going to be $1.3 million on your 10 houses. And then your total on your 2 houses is going to be $567. But that's not quite where the story ends. And then your cash on cash return, now what you're looking at is obviously much better than it was over 5 years. So you're talking about 175% cash on cash return. That $500,000 that you invested over that 10 years has now gotten you a cash on cash return of 175% over those 10 properties, and only 13% with your 2 properties. The average annual return now is where you're starting to outperform the S&P 500, right, at 17.52% on that cash on cash return. If all things actually play out this way, average annual cash on cash return at 1.3%. But to go a step further, one of the things that we haven't talked about is equity, right? Because, we now also have to presume that we're building equity in these properties. And so equity accrued over that 5-year period is $67,000 for your 10 finance properties. your equity was the original investment that you made. So you've got that same $500,000 that you're sitting on, because we're breaking this out a little bit different. People would normally talk about equity 5 years in the future, including the entire value of the home, but we've broken that out to a difference in appreciation versus initial equity. So you've got your same $500,000 in initial equity on those two purchase homes. And then what does that look like over 10 years? So now, after 10 years, you've built up to where you've got $319,000 in equity over your 10 homes that you financed over those 10 years, now brought you 319, and you're still sitting on the original $500,000 in equity for your two homes that you purchased at $250,000 each. And so your total liquidated return. So after 5 years, if you're going to say, you know what, I'm going to be in it for 5 years and then I'm going to get out of it. One looks a little bit different, right? So your total liquidated return. So we're taking into account your total cash flow, your total appreciation, and your total equity that you've gained in this home over that 5 year period. For the 10 homes is going to bring you $723,000. Your total liquidated return for your two homes is going to bring you $777,000. So you are better off if you're saying, hey, I'm going to buy them and I'm going to hold them for 5 years and no more. You're better off taking that $500,000 and buying your two properties at $250,000 each and letting real estate do its magic, right? And make
Right.
you a fair amount of money. But if you're going to do what most people, so the wealthiest of the wealthy, and look, we talk to people all over the country, investors at all levels, and the ones that probably the most frequent phrase that I hear from the wealthiest people that we meet is never ever sell, right? Buy and never ever ever sell, or I bought and I sold and I regret it, right? So if you're someone that kind of takes more of that stance, which is okay, different people have different investment thesis and strategies, and that's perfectly fine. If you want to invest for a little bit longer period of time, look at the difference when you get to 10 years. So now your total liquidated return with your 10 properties after 10 years that takes into account your cash flow, your appreciation, and your equity is now at nearly $1.7 million, where your two homes is at just a little over $1 million. So a pretty dramatic swing. In this, you can see the delta from 5 to 10 years. You can imagine how this balloons over 30 years, and we're not going to walk through every individual thing for the next 30 years. But this shows that your liquidated return on investment after 5 years with your initial $500,000 down is going to net you a 44.7% return. Your liquidated return on investment after 5 years is better at 55%. Your liquidated return on investment after 10 years, 239%, or an average of 23.9%, where your liquidated ROI after 10 years is 113%. Still, that's 11.3% per year. Still slightly outpaces the S&P 500. A great plan, great idea. But this is when a lot of people that are talking to you, Andrew, when they're talking to us and they're saying, hey, I've got a lot of money like that I want to put in real estate. Number one rule of real estate, use other people's money. And when we're those other people, if they take all of their money, they're going to take that $500,000 and they're going to be able to buy two properties with you, Andrea, in Ocala. They're going to be great performing assets for them. It's going to be an amazing investment. Or they can expand that and say, we can take that same $500,000 and now we can buy 10 properties instead of two and let real estate do its magic.
Yeah. So, as people are looking at this, they're probably thinking, okay, this guy, he knows these numbers and everything, but he's definitely pushing for the finance. But you said it yourself, cash buyer, if you're only going to hold it for a few years, cash is probably better. So, this is really more, if you're going to hold it for about 7 to 10, finance is actually a better option for you with the numbers that we have in place. And I know a lot of people are like, but I've got it in, stocks, and I've got it in this, and I've got it in that. This might not actually happen. This is actually extremely conservative, what I would consider, because in my own personal experience, my husband and I, we have an LLC, we have, some properties that we purchased, and our numbers are actually even way better than this, because of course we had a boom here in Ocala and, Central Florida, and it's still continuing. We're still at the beginning stages. We still have a lot of industry and warehouses and distribution centers and stuff like that that have yet to even break ground, but have already purchased and they're ready to go. So we're still going to continue that for several years going into the future. So to see that and to see these numbers, and for any of the people out there going, that's not this is real. This is actually very conservative numbers, which is what I truly appreciate. I actually really like having, the conservative numbers as opposed to something, maybe something that it's big promises and under deliver. I don't do that either.
Well,
So yeah.
well, we didn't want to look. The idea here is not to have. I mean, every number is not going to be to the penny.
Oh,
This in
good grief,
reality,
no.
right? But it's to give you kind of a pro forma of if you're looking at these two different strategies, which is a better idea for you. And the one thing that we haven't talked that we didn't address in this, and there are a lot of things here, right? There's the cost of vacancy, there's the cost of maintenance, there's the value of the depreciation that you can take, right? As a tax strategy, right? And we're certainly not, this is not investment, legal, or tax advice. This is just kind of giving you a pro forma of something that could be a possibility. But we didn't talk about that. We didn't talk about, the annual rent increases of 3 to 5% per year. I mean, and how that's value, that value really compounds over time. So these are all ideas, they're theories, but this is certainly the way that people are evaluating these type of opportunities, because there's a lot of people with a lot of dry powder that are sitting on the sidelines. They're saying, hey, we've got a lot of money, we're ready to deploy, but they're just not sure where and how to deploy it. They don't know what's going to be the best return for them. And so I think Andrea and I would both, tell anybody who's listening the same thing. Talk to your investment advisor, talk to your lawyer, talk to your accountant, and talk to amazing real estate professionals like Andrea, who can put you in the right investment vehicle when that time comes. Then certainly, we would love to help perform for anybody out there that is interested in going the financing route. We obviously have, these types of products where, we can be of great benefit to investors. But this is the story, right? Nationwide, right? Everybody's been talking about, survive till 25. Now interest rates are starting to come down. The Feds recently made their cuts, and so we're seeing interest rates have moved down. Will they continue to move down? Will they go back up? Nobody can tell. All we know is what is today, and that is kind of the rule of real estate is there's nothing guaranteed other than this moment, this breath, this second. But as it sets, this is the information that we have at the time.
Yeah, well, we definitely didn't see the pandemic coming or anything like that, and how, when it did hit, and it was pretty sudden as far as I was concerned. I don't know. We didn't know how it was going to play out. We really didn't. It was just worldwide, and just overnight everything shut down. And yet here in Florida, we had all of our tenants paid their rent still. Everybody was, we were still able to do a lot of things that we were living. And I know that's not the case in everywhere. And I know there's, again, we're very landlord friendly. We've got some anti-squatter laws that just came into effect, and, evictions are pretty quick. So even if they're not necessarily investing just in Ocala or Central Florida, investing in Florida itself, I think, is actually a really, really smart move. And there's some pretty good deals out there.
Oh, yeah. Yeah. I mean, look, the landlord friendly states are certainly where a lot of investors we see flocking to, right? I mean, anywhere in the Sun Belt is considered generally safe. And that's certainly where we see a lot of investments heading.
Yeah, I definitely agree. So, and it is, nice having an actual building and land. They're not making any more land, right? So to have that as opposed to a stock that is, it's a thought. So it's just something that you can actually see, feel, touch. Some people really, really like that. Or, just diversify and do both. I mean, that's also an option too. So I greatly appreciate you coming on here, man. This has been absolutely amazing. Like I said, I've been looking for a few years now for somebody that really truly wants to work with investors in the way that investors expect and want, and to provide a service and a product that's going to be for them. And I think this is it. So greatly appreciate you coming on here and explaining and answering all of my questions, even with all the disclosures.
Yeah, no, absolutely. Well, look, I mean, we are a real estate investment lender for real estate investors on real estate investment property. It's literally all we do all day, every day. So we'd love to help out, and I'm sure you'll drop a link somewhere in the
I will.
description
I will
of how
absolutely
people
have your
can
information in there. So, we'll make sure that and if you want, you have a newsletter that goes out as well. So they can actually sign up for the newsletter. So I will definitely
absolutely.
make sure that there is a link in the description so that they can go ahead and sign up for that so they can get, updates on stuff that's happening. Because I love those newsletters. Those are great.
Yeah, fantastic. All
All right.
right, that's
Thanks so
amazing. Well,
much.
thank you so much for having me. I've enjoyed it.
All right. Thank you.
You've been listening to What's Up, Ocala? Follow us all week on Andrea Praber's YouTube channel and TikTok. We'll see you next week at 10 a.m. on What's Up, Ocala.